The only headlines that I've seen is one, maybe we should regulate payment for order flow.
Of course. Do you know who understands payment for order flow? Nobody. Payment for order flow is what allows everybody who wants to trade the ability to trade. It sounds horrible. It's a horrible name. Payment for order flow. It sounds bad.
Sounds like a bribe. It sounds like a bribe.
It sounds like a bribe. Payment for order flow is what makes the system work. It's
why? What is it? Educate the people here. I mean, okay. This is probably a targeted audience, but still, what is it?
Okay. So payment for order flow just means that you, Dylan Ratigan, as a customer, you route an order to Tastyworks, whether it's an option order or a stock order, whatever. If it's a futures order, there's no payment anyway. But if it's an option order or it's a stock order, you route it to us. Rather than us send it to a specific exchange, which, mind you, we don't know which exchange to send it to. There's a primary exchange, but there's lots of exchanges. There's 30 stock exchanges. There's 11 option exchanges. Everybody kind of shows the same market, but nobody shows their best market. So we don't know where to route this order to. So we have a choice of 40 different exchanges, let's say all told. We would have to maintain connections to 40 different exchanges and somehow hope that we get the best price back. What we know for a fact is that every single one of those 40 exchanges will rip off our customers every chance they get. So along comes a brilliant system from the guys at Citadel, from the guys at Susquehanna, whether it was Timber Hill years ago or whether it's IMC or whatever it is. Along comes a brilliant system. We will create a competitive marketplace in cyberspace. And so before your order goes to the exchange floor, we're going to match it up competitively among as many as 50 different firms. And within 1 or 2 milliseconds, you're going to get the best possible price. Why is it the best possible price? Because it's got to be at least as good or better than the exchange prices so that these firms can participate on a greater share of the order. So before that order goes to the exchange floor, all these firms compete for it. They give you a better bid, a better offer, or at least as good, but most of the time it's better. It gets to a competitive marketplace, and then the order gets routed to an exchange where they're making markets, and in return for them executing part of that order flow, which is just scale, they pay us.
So basically, the payment for order flow is really a technical platform that's optimizing for best price from the exchange. The service that Citadel or Susquehanna is selling is price optimization from all the exchanges.
So then what happens for the customer? A, the customer gets a better fill. B, the customer gets a more competitive market for what they're trying to do. C, the customer gets to trade on much better technology because firms like Tasty only have to worry about routing and building technology to go to 6 or 7 or 10 different liquidity providers as opposed to 40 different exchanges. D, they have better technology than the exchanges have, and they're constantly updating it so we can support better order types and everything else. And then E, it reduces the cost of commissions because we don't have to pay the rip-off exchange fees and the rip-off fees to these various exchanges, which are all publicly traded now. And instead of us paying them, they pay us. So in turn, the customer gets free commissions or ridiculously low rates, and they're subsidizing that. So everywhere, the whole process, the customer wins, the brokerage firm wins, the technology wins, everybody's better off.
I guess other than the exchanges who are forced to tighten their spreads.
No, the exchanges still win because what happens is the amount of business has gone up by 100%.
Whatever they lose on the spread, they more than make up for on velocity.
It's all scale. So what's happened is they've made it up on volume. It's the volume has gone up. The volume's gone up 50% a year. It's crazy, 35% a year, because they finally figured out we can't make tight markets, but these high frequency firms can. If we go back to the days where they outlawed payment for order flow, everything is going to suck. The markets are going to suck. The whole business is going to go down the tubes. And it's really sad because, again, it's just the optics, the narrative of payment for order flow sounds bad.
Sounds like a bribe.
But it's what's completely revitalized and changed the entire business. It allows Dylan Ratigan and Tom Sosnoff to make a trade and basically to roll up and down options, to do everything that we want to do with stock options and basically futures, and to do it on a single platform with amazing technology because of high frequency market making.